Good morning. My name is Don Vivrette. This is the first week of It's Your Estate. We'll be discussing an introduction, covering what all the first overall will be about, and then we'll be doing a tax update. So that's where we will be going through this. So Pete, would you like to get us started?
Sure. We're still getting people online. I'm looking at it.
Yep.
And the It's Your Estate series and the It's Your Money series was started when I was at Long Beach State University and as their planned giving director. And planned giving means that you're encouraging individuals to give to a charity through their will or trust, some kind of a gift, but that doesn't take effect immediately, but sometime later in life or at their death. In order to talk to people about that, they need to understand a little bit about estate planning. And so we began the program called It's Your Estate. And what happened was when my father died, it really became crucial to me that having the estate planning documents here in Orange County, of 3 million people, becomes vitally important while you are alive. You know, I always thought of these documents as something that you do to prepare for death, to take care of the heirs and, whatever. But incapacity is the primary reason why I think today you should prepare your estate plan. And so my dad was in the hospital for a little over 6 weeks on a ventilator. And so during that period of time, we did not have a document called the Advanced Healthcare Directive. And I have 3 sisters, and we all had differences of opinion as to how my dad's health ought to be handled. And so this caused an immense amount of confusion. Doctors didn't know exactly what to do, et cetera. And in the meantime, I felt that my father wanted to not be on the ventilator and he wanted not to be intubated. So it was a terrifying experience. And one of the reasons why today we're doing this program called It's Your Estate. I was going to call the program It's Your Death, and then I didn't think anybody would come. So I'm glad you're all living and participating. But the other thing too is that when you talk to somebody about estate planning and they give you an hour and they tell you, okay, you need a living trust. Well, what we have done is broken down the entire estate planning area into 8 sections. Don, could you bring up our website? And
I'm going to share this.
And it has a schedule on there. And today we're going to focus on the It's Your Estate section. So if we bring up the fall schedule.
Let me move something out of the way here.
Okay.
Fall schedule.
Yep. And if you look at the right-hand side of the schedule, that is our program for the next 8 weeks. And so the idea being is that we take an hour and a half on each section to educate you on the estate planning basics and kind of an overview how important title is to the whole concept of estate planning. Just yesterday, after our meeting, I had to go to Schwab to put, I'm a successor trustee, and the person's durable power of attorney. And the individual that I'm a trustee for, 92 years old, and just got out of the hospital because of a stroke. She has all of her accounts with Schwab, no bank accounts. And she needed a caregiver immediately. And so I had to hire a care manager and a caregiver for 24/7 for her. Yet I had no money to do it. So going into Schwab, telling my story, the clerk goes, it'll be 2 weeks before you're on the account and be able to get any money. And so it goes to show that you need some practical information so that this doesn't happen to you and that you can prevent some of the stuff from happening. So we're going to have, for each section, we're going to have estate planning attorneys speak. Don and I will be moderating these sessions, and all of the presenters are coming in as volunteers. Our mission, we finally formed a not-for-profit, and our not-for-profit is called Financial and Estate Literacy. And by the way, the financial literacy in the United States is next to Botswana. We're just not, although we're a very capitalistic country and money is very important to us, the knowledge about the financial services industry and even about estate planning is not great. In fact, the vast majority of people do not have an estate plan. So, and it doesn't matter what kind of wealth you had. You read about celebrities dying without a will or a trust. Howard Hughes had a handwritten will, which was crazy. And nobody likes to pay an attorney just to get some advice. So each one of these sessions is going to be handled by an attorney. And one of the first things that we'll be doing with that attorney is talking to him or her about what it costs to put an estate plan together. So the third session that we have is planning for incapacity. And that's where we go through the durable power of attorney and the advanced healthcare. We'll spend an hour and a half on living trust, charitable income and tax planning. People just don't understand charitable remainder trust, charitable gift annuities, and where they can really provide some financial benefits. And at the same time, you can do some really tax-wise giving. Retirement account planning is just, people have a lot of money in their IRAs and their 401ks and the 403bs. And all the rules regarding retirement account planning are driven by the IRS. And so we're going to have Michael Simon speak on that. He's one of our best lecturers on retirement account planning, and I think you're really going to enjoy him. Duties of trustees and executors, we'll come back and we'll talk about that. And we know that the vast majority of you are going to be naming a family member to handle this particular duty. But not whether you use a trust company, whether or not you use an outside professional or a family member, fiduciary liability is huge. So we're going to give you a checklist of what to do, what not to do, and you could talk to your family member about that. At last, we'll have a case study and review. Hopefully, we'll have some practical issues that will come up, and at the same time, review the previous 8 weeks, because hopefully you'll have some knowledge of the terms that we're using, and it'll hopefully come together. We have charitable sponsors. And the reason why we have charitable sponsors is that allows us to pay for putting these Zoom presentations together. We have a website tech person who helps us with the Zoom. We have one other employee, Sylvia, who handles all of our correspondence with the presenters and with the attendees and also with our sponsors. We do not have for-profit sponsors. And the reason why we don't have for-profit sponsors is that we don't want you to be sold anything. To put education and selling in the same category. I know if I went to a program and somebody was trying to sell me something, I'm not going to get educated, and I'm going to stop listening, and I'm going to get very cynical. So we have just charities as sponsors. And the reason why another reason why we have charities as sponsors, besides the fact that they provide income to financial and estate literacy, is that it's really good to give. People who give live longer, are happier, and we hope that we can encourage you to do so. So our mission for financial and estate literacy is threefold. One is to educate you about money. Two, to educate you on charitable planning. Three, to educate you about estate planning. Education is the key. So we need feedback from you through our, is it chat, Don, how they can give us feedback or ask questions?
Let me come back. Can you hear me, Pete?
Yeah, I can hear you.
Okay. I can't see the bottom of my screen. We'll talk about that in just a minute. So okay. You want to talk about the materials that are available on the website since we're here?
Yes, I just want to make a few comments about the charitable organizations. The charitable organizations, we have invited them to come in and talk a little bit about their charity, about their mission at the beginning of a program, later on at some time in the next 8 weeks. Some do, some don't. But if you ever need any help with finding a good charity, Don, by the way, is on our board of directors for financial and estate literacy. He's also on the board of directors for the Laguna Canyon Foundation, and he's our philanthropic advisor for financial and estate literacy, besides being the moderator for helping out with moderating for our program today. So he's kind of besides being a CPA, he does all sorts of stuff. And we'll introduce Marty in a little bit. So hang in there. Let's go to the materials page.
So this is the website if you bring it up. And as Pete has noted at other times, it used to be you had to type in itsyourmoneyandestate.org, and now it's iyme.org. We'll get you into here. So it's a shorter way of doing it. And I'll show you that in a minute. You didn't have to remember it. So I'm going to click on workshops. And if I bring that up, there's a button over here called materials.
Why don't you click on it?
I'm about to. I'm just letting them catch up to me in terms of where it is. If I click on that and I want It's Your Estate, then you scroll down, and this is the session we're in today. So Marty's materials here. And if you went to any of the other 8 locations, that's where they are. And each week, I'm sorry, let me make you dizzy. There will be the video recording will be shown here. So after roughly a few days or something, it would show up here, and that's the video. Then you come down and you'd have week 2. Same thing goes on through. So all of the material, there's no more handouts anymore in terms of what we do live. And obviously on Zoom, there wouldn't be handouts. But you can go here, download these, read them, print them, whatever you want to do to them. So all the material for all of the sessions will be here. And if you wanted to take the estate one, I'm sorry, the money one, same principle. You click on that one, there's the material for money. So if you're only doing estate, you can go get the money materials if you want. But that's where all of that is.
The other thing too is that we're doing both Zoom and live sessions. So every location has different speakers. So if you're wanting, one of the benefits of our program, I believe, is that you could see different presenters at different locations. Let's say if you're looking for a financial advisor. Same thing as far as attorneys are concerned. We have attorneys who charge $1,000 for an entire estate plan, and we have attorneys speak who charge close to $8,000 to $10,000 for an entire estate plan. They have different personalities. All of our attorneys who are speaking in our program series, though, are estate planning is their primary area of focus. So if you go to a website for an attorney and you see that they do estate planning as 1 to 20 things that they do in the legal area, from my point of view, I would avoid that kind of individual. You need today, because of the rules change and the technical aspect, you need to be a specialist. And all of our speakers are specialists in the estate planning area. And we'll introduce again all attorneys and ask them how they charge, so you can negotiate on your own if you wish to go in and with any of these attorneys to have your estate plan done. The other thing,
one note incidentally, because I'm sort of scrolling through the various sessions and where they all are. Generally, we follow the same pattern for all the sessions, but they're not necessarily in the same week. So there are different start dates. So if you said, oh, I want to go see such and such, make sure you check the date. And I know on some of these, there are minor changes just because of availability. I know I'm doing Tribuco one in terms of Irvine, and we had to shift the date because of availability. So that's not a problem, but that was also done. So, but know that they aren't always on the same week, so you can check the dates and times and locations for them.
And all the presenters are volunteers. None of the presenters will get your contact information. So if you want to do business with any particular individual, it's up to you to contact them. And one of the things that what we do with each speaker and each presenter, we provide you what we call the Ask First form. We have a blank one on the materials page, and we have the presenters Ask First form. My Ask First form is on the presenters page, the material page as well. We're not going to go through my Ask First form. You're welcome to take a look at it yourself. But let's go through our presenters today. I'm going to spend a little longer time on the Ask First form today than I will with the other presenters, because some of the things on there are a little bit subtle, and I kind of need to kind of explain the importance of knowing this information before you start doing business with either a financial planner where you talk about your money, because there's all sorts of free dinners out there. There's seminars out there. Everybody wants to do your estate plan, and they want your money as well. So it's your money and everybody wants it. So we want to make sure that you don't get scammed. Okay. That's one of the #1 rules. And that financial abuse in the estate planning area, in the financial area, is just huge. It's flying off the charts. It's the #1 rising crime here in Orange County. Financial abuse is committed by who? Don's family.
Against Don.
We all think that it goes to the outside, you know, it's the caregiver, it's the, it's the broker. Yeah, there is some of that occurring. I mean, Bernie Madoff and his wannabes are out there. And you get those kinds of solicitations on scam calls, on multi-level marketing, on and free dinner seminars. They're there. But the vast majority of financial abuse is committed by family members. Okay? So we want you to make sure that you have and prepared and to look at your family objectively in this area. I want to introduce.
No, before we do that, let me do this. So on the bottom of your screen, and you may have to move your mouse to wake it up. I know on mine, because I have a laptop over here as a participant. If you move the mouse or shift it a little bit, it'll pop up on the bottom. There's a thing called Q&A. If you click on the Q&A, it pops up, and Pete, Marty, and I will get those as they come in. I'm going to be monitoring them in a couple of minutes. You'll see that where I sort of disappear and I become the voice of God in the distance of asking questions and following up for you. If I can answer them, I just ask them as we go through. But that's the best way to do it. There's a chat. Those are harder to use from our side. So I would ask that you use the Q&A. That's a really good way of going through and doing it. We've talked about it. When you, on a weekly basis, you will get an email that says, tomorrow you're going to be watching the estate. And then an hour before, you're going to get another one. And in there, it has the link. Click on that, and it'll take you to the materials page. That same location as you saw will also get you to the videos as we go through them. So those are my background things. Marty's going to appear here in a moment.
First of all, before we continue, Trevor, why don't you show your face for a second?
Trevor may not want to.
Yeah, may not want to. Trevor is our president for financial and estate literacy, and he's also going to help moderate some of the sessions. There you are. And so if you have any questions, please feel free to ask Trevor as well.
Nice to meet you guys. I'm just checking in, making sure all the people
Thank you, Trevor.
Supposed to do. Looks like everything's going okay.
Yes, it is. Don, could you go to the materials, not the materials page, but the page on our website that has all the articles?
Okay.
And then we'll get to Marty, and we'll introduce Marty, and we'll get to the tax update.
And I'm going to share that screen in just a moment. So you want to go to the materials page?
Yeah, the articles page. Go to articles on top.
I'm sorry, I thought that was under materials.
No, see the articles right on top? Articles.
Articles.
You got it. So we have just a lot of articles on our website that might be related to a particular week of the program. We also have it on the workshop site. If you go to workshops.
Right, yeah, that's where we just work. Under materials, it's here.
Yeah, and then go to the It's Your Estate. Yeah, there you go. And
there are frequently articles that will be in here also.
Yeah, so yeah, we'll get, we're still working on that.
So there they are. Here are all of the articles. At the
Oh, there
end of
you
week
go.
One.
Okay, there they are.
They're right here, yes.
Yeah, okay, there you go. Thank you for helping me out, Don. I appreciate it.
We're dancing.
Okay, Marty, come on back. There you are. Okay, let's pull up your Ask First form.
Okay.
And I'm going to disappear.
All righty.
I will speak when I need to.
Thank you, Don.
Can you see the Ask First form?
I can't, whatever you did there just a second ago, on my screen,
I'll try again. Let's see
Okay.
here.
And on my participant screen, it worked just great.
Okay.
Okay, there it is.
Okay, great.
I can see it really well on my screen now. Go scroll, do you have scroll down for all the way down to the bottom to the next page? I think you have it, but I'm not sure if it's, okay, you don't have the other page on there. That's okay. I just wanted to give kind of an introduction as to why the Ask First form is important. When I was at Long Beach State University and dealt with PhDs, master degrees people, in other words, very, very smart people, and I asked them why they chose the financial advisor or the advisor that they were going to. And they just assumed that if you call yourself a financial advisor or you call yourself a tax accountant, that you are what you say you are. And that's not really true. And so there's a lot of people who try to be something and they don't really have the experience or the education background to do what they say they're supposed to do. So the number one reason why people said they were going to their financial advisor or to their accountant or to their attorney was that they were very nice people. And, you know, so being nice is really important, but you need to know some basic facts about the individual. First of all, what's your education like? Marty, where do you have the bachelor's degree in?
Finance and accounting.
Pretty good if you're going to do financial advice. You're a CPA. See where it says a credential and a license. A lot of times, especially with a CPA, because you're licensed by the state, is that correct?
That's correct. I'm
Yeah.
licensed by the state of Ohio, actually.
Yeah, well, yeah, in most states, this is one of the few designations that are almost regulated by the state. Or excuse me, one of the few credentials that are regulated by the state. Because can somebody just take a 2-week course and become a CPA?
No.
Yeah. So whereas a license, you know, how long did you spend on studying for your driver's license?
I didn't spend any time and failed my first attempt when I was 16.
Yeah. Well, you know, licensing is a minimum qualification with the state to project to the public as to what you're doing or operating a vehicle. It doesn't make you an expert. So the difference between a credential and a license is really important. And some people who are professionals, try to pass off a license as a credential, and you just don't want to do that. By the way, there are over 120 different designations in the financial services industry. And I'm going to put attorneys who do estate planning in that category. So what does a PFS mean?
PFS stands for Personal Financial Specialist.
And who's that given by?
It's given by the American Institute of CPAs, and it's only available to CPAs.
So you have to have the CPA first, and then what do you have to do in addition to get the PFS?
In addition to being a CPA, you have to be specializing, spending a certain amount of hours per year doing financial planning related services in your practice. And in some cases, you have to pass an exam. I didn't have to pass an exam because I had the certified financial planner exam. And so the AICPA recognizes that as kind of a grandfathered in way to get the PFS designation, but it's, you've got to be spending a lot of your time working as a financial planning specialist.
Okay. So in other words, you can't just buy that designation.
Correct.
Okay. So the other one is a CFP, which is probably today the most recognized one, but what does CFP stand for?
CFP is Certified Financial Planner.
And what did you have to do to get that designation?
So because I was a CPA, I was grandfathered into an exam. I just had to sit for the CFP exam. if you're not a CPA or a CFA or an attorney, then you have to go through a curriculum that's pretty rigorous. The coursework has evolved over the years, but you learn about things like investments, financial planning, retirement planning, income taxes, estate planning, insurance, employee benefits, Social Security. And so there's a pretty specific curriculum that's really just focused around personal finances.
Yeah. So the CFP, the way I like to describe it, it's a mile wide and it's about an inch deep. In other words, it gives you, I compare it to a primary care physician that just has a broad knowledge of your health. And then if you need a specialist, can guide you to that specialization, or they, in fact, themselves specialize in one of those areas. So you have 18 years of relevant experience. Do you see your group or your firm specializing in any one particular area, or do you try to be just a broad financial planner?
Well, I think we're broad financial planners, but because we're also CPAs, we tend to have a pretty strong tax planning bend, income tax and estate planning bend to what we're providing. Our technical skills in that area are typically a little stronger than some of the other CFPs that do not have the CPA designation.
Yeah, I think that's a fair way of describing your firm. In fact, tell us a little bit about your firm as to what you do and how you do it, because I understand that you don't practice as a CPA.
Correct. I have the CPA designation, but our firm does not offer traditional accounting services, right? So we do not prepare income tax returns, and we don't do bookkeeping. A lot of those services that are typically associated with the CPA is not something we're doing. The services that we do provide, I would describe as investment management and financial planning. Okay. And financial planning can be pretty broad, and then it can cover a lot of different areas depending on the needs of our clients. And those needs tend to evolve with life and their goals throughout life.
Okay. So your relevant license is your CPA license, and they can look it up. You also have a Series 65. Series 65, you issued by FINRA, is not really a license. It's more of a registration. The financial services industry operates on one really basic premise, and that premise is full disclosure. If everything is disclosed to a potential client, then the client can reasonably make up their own mind as to what they want to do. So in the financial services industry, usually a prospectus is the full disclosure. FINRA is, well, let me ask you, Marty, what is FINRA?
The Financial Industry Regulatory Authority.
Is it a government agency?
Yes.
No.
It's not? Okay.
It's a self-regulatory organization.
Oh, it is. Okay.
So
that's where, and maybe you'll talk about this, Pete, but we're not although I have my Series 65 through FINRA, right? We're regulated by the SEC.
Yes.
My firm is.
Yeah.
So
because
I'm a little bit less familiar.
Yeah, and the reason for that is you don't sell anything.
We don't sell products.
Yeah,
exactly.
And so the Series 65 is a full disclosure document. If you were to see some of the other series numbers, like a Series 7, a Series 2, or some of the other numbers on there, then you would know. And if you saw FINRA on his business card, you would know that he was a commissioned or could be a commissioned commission salesperson. So the fact is that FINRA regulates commission salespeople, but they also regulate or put together a program called broker check. So besides the ask first form, anytime somebody is going to talk to you about money or financial advice, you should Google broker check, which will get you to the FINRA website, plug the individual's name in there, and you could see whether or not that individual has any disclosures. So, you know, as I said before, we have 120 different designations. And so people want to come across as very professional advice, don't want to be considered like a salesperson, but the only way you can kind of check out that individual is by going to the FINRA broker check and using the ask first form.
Pete, Pete,
Yes.
someone whose picture is not showing on the screen sent us a note that said, FINRA is a government authorized not-for-profit organization that oversees the US broker dealers. So just
Correct.
as someone whose picture was here a moment ago and isn't there now, wanted us to correct the technical definition.
Okay. I think
Thanks,
that's
Trevor.
Thank you, Trevor. But it is a self-regulatory organization. And what does that mean? It means that Merrill Lynch, Morgan Stanley, Bank of America regulate themselves in the financial services industry. And one need not go any further than that. Legal services, you don't provide legal services, but in your practice, you review estate plans. Is that correct, Marty?
That's correct.
And there's a lot of tax issues involved with estate plans, and we're going to go through some of them. But IRA, annuities, cost basis, step up in basis, depreciation. I mean, there is a lot of tax issues in the estate planning area. And
Definitely.
okay, business relationship. You will serve as a fiduciary and put your interests before your interest and those of your employer. So you own Merrick Wealth, so you're your own employer. Is that correct, Marty?
Correct.
Okay. So, and you will treat the fiduciaries or treat your clients and put their interests before your own.
Correct.
Okay. And so when you say compensation, you take a salary out of your corporation or out of your firm and any profits at the end of the year. But how do you charge your clients?
We charge our clients as a percentage of assets that we manage. So if the client has, $1 million of assets in their portfolio and we charge approximately 1% per year, that would come out to $10,000 per year. That $10,000 is deducted from their accounts on a quarterly basis.
And do you work ever on an hourly basis?
Yes, we also do hourly engagements from time to time, although it depends on the situation. Sometimes we end up referring that to other financial planners.
Okay. And do you offer a free initial interview to see whether or not there's any kind of compatibility?
Yes.
And what should somebody bring into you or show you in that first meeting to see whether or not that there is a match there?
Yeah, we like to look at their assets. So if they've built a balance sheet or a net worth statement, that's great. If not, we want to help them do that. And so account statements and just general values of all their assets that they own is a great starting point. And then we also like to look at their income tax returns.
Okay. And when you are engaged with a client, is there a limit to the number of contacts they have with you? Is there a charge for extra phone calls or personal visits?
No.
Okay, so how many clients do you have at the present time?
My firm services about 70 clients today. I am the lead advisor on approximately half of those relationships, and my business partner, Patrick, is the lead advisor on the other half.
Okay, and let's go through this where it says compensation on the sheet. It says you own Merrick Wealth, correct?
Correct.
And so the client pays essentially you.
Yes.
And do you get compensation from any other source?
No.
Okay. This is a little subtle, but I just want to compare that to a person who works for Merrill Lynch. We're going to pick on Merrill Lynch for a little bit. Joe Blow works for Merrill Lynch. You're Joe's client. Joe, when you pay Joe, you really don't pay Joe, you pay Merrill Lynch because they're the broker dealer, they're the supervising entity. So you write out the check to Merrill Lynch. Who pays Joe? The person who pays Joe is Merrill Lynch, not you. Who's Joe going to be obligated to? Merrill Lynch. So when Merrill Lynch says, hey, we need some more limited partnerships sold, Joe takes that and tries to sell you a more limited partnerships. If there's a contest within the firm, Joe goes out and does whatever needs to be done to win that contest. Joe, if Merrill Lynch is not paying him enough, remember, it's almost like a real estate agent. You have First Team, you have Caldwell Banker, you have a variety of real estate firms. Well, when you are with a real estate firm, your commission that you receive when you sell a property is split with that firm. And so when you first start out, you might just get 20% and the firm gets 80. And as you grow and get more clients, it might be 80-20. So when you see a lot of financial brokers changing firms, most times it's about that commission structure that they're going to increase their own personal commission with the firm. The firm has supervisory responsibility for their sales agents, and that's essentially what they are. But they don't like to call themselves a sales agent. So they dress themselves up to be as professional as possible with designations behind their name, but they're essentially selling you financial products. In fact, you're not going to be very successful at Merrill Lynch or Morgan Stanley or anywhere else unless you have the ability to sell. Okay? Enough on that. Financial products or affiliated organizations. I'm assuming, who do you custody with and why is that important? And what does custody mean?
Sure. So the independent custodian that my firm uses is Charles Schwab. So our clients open up accounts with Charles Schwab. We get access to those accounts to do really three things. One, we can view the accounts and access data on those accounts. Two, we can trade on their behalf. And then three, we can debit the agreed upon fees from their account.
You have a limited power of attorney over that account.
Correct.
So what
Correct.
happened in Bernie Madoff?
Yeah, Bernie Madoff's firm was the custodian and the manager of the investments, right?
So it's
So,
so it's really
we are not
important to have
the
a custody.
custodian.
Yeah, so it's really important to have a custody completely separate and apart from you. Do you
Correct.
get any kind of kickback from Schwab?
No,
And so if you make a trade on behalf of someone with Schwab, does your clients have to pay that fee? And what would that fee be?
it can vary. It can be $0 to as high as $25 for a transaction fee. The fees have come down over the recent years with respect to that, but the client pays that directly to Schwab. So it's deducted from the client account and goes to Schwab.
Okay. So, so it's a minor charge, but there's no kickbacks going on between you. Schwab does have a program though, where financial advisors such as yourself can be in their network, supposedly, where there's some sharing going on as far as fees are concerned. Are you familiar with that, Marty?
I'm not as familiar with that program, Pete.
Okay. But again, it's just very important to understand how the compensation is and what you're paying to the financial advisor, because it's your money. You're the employer, they're the employee. You work together as a team, but it's independent. You still are in charge of your money. It's just that your advisor now serves in your best interest. In the estate planning area, it becomes really important. What I find out there is that the spouse dies who's been handling the money. And it could be the male or it could be the female, but usually within a marital situation, one person is kind of handling the finances. What happens when that person becomes incapacitated or dies? Well, immediately what I see happening is that the children step up to the plate and tell mom or dad exactly what to do. And most times they have no clue as to what they're doing, but they think they know. And so all of a sudden, when somebody dies, you are in a state of shock. And all of a sudden you get this pressure from the kids as to how you should be investing. Well, when one person dies, and we're going to see this in just a little bit, the tax rates are completely different, whether you're single or whether you are married. So whether or not you use a fiduciary financial advisor, fee-only fiduciary advisor today, keep these ask first forms, because maybe sometime in the future, you need somebody who's independent, who will help you stay independent in your financial matters, that can handle you through some of the rough periods. All right. By the way, this is not all there is to know about Marty. Marty is a very nice guy. And why don't you put up your little bit of your bio?
Okay, I'm going to stop the share and then I'll share the presentation for today. Okay. There you go.
There you go. 18 years. Deloitte is what kind of firm is that?
It's primarily a tax and accounting firm. Was the area of the firm that I worked in. It offers other services beyond that, consulting being one of them.
Yeah, it was one of the big 5 or big 10 or one of the big accounting firms.
Yeah.
And you also worked at Northern Trust, didn't you?
That's correct.
So you've got some trust company experience, which I think is really helpful in the estate planning area. So you could talk to people about what is what it's like being with a trust company. I think you've got some really excellent experience there. And you also worked with a financial advisor in a boutique firm as well in your background.
Correct. That's right. I've worked at 2 boutique financial planning firms. One was in Ohio, one's in Newport Beach. And so had 4 different stops before I started my firm.
Yeah. You just didn't jump into your own firm. You've got a solid background. And the fact that you have 3 kids and a golden retriever, you need to work. Okay, let's go to the presentation.
Okay, so today we wanted to talk about taxes and kind of broke it down in some different areas. Federal gift and estate tax is one type of tax. I want to talk about property taxes here in California. That third bullet point is income taxes, and we'll spend the bulk of today talking about income taxes, including potential changes to the current income tax laws, and then just income tax planning considerations. Okay, so federal gift and estate taxes is an area of the tax law that does not impact most U.S. taxpayers. However, for those that it does impact, it can be very meaningful to understand and to plan around, because there's a lot of opportunities to plan for this tax and to reduce it, if not completely eliminate it.
You know,
the reason,
since this is the estate planning course, talk a little bit about when people ought to be making gifts and within families mostly. So grandma to grandchild, parents to child. Talk a little bit about the whole gifting area besides just the annual gift tax exclusion.
Sure. Well, we think that people should make gifts when, or at least give some consideration to it when they've identified that they've got more assets in their estate that they're going to need. Right. So they've saved up enough money, they have enough net worth to last their lifetime and then some. And that's especially the case if those assets in their estate are over this $11.7 million estate exemption amount. Because if they are to pass away with more than this $11.7 million, anything over and above that will get taxed at this 40% rate. And so giving assets during their lifetime can help them reduce their estate below that $11.7 million and avoid taxes. Now, I'd like to say that 11.7 million is a per spouse. So if you're married, you can essentially double that number to $23.4 million for a married couple. Now, these thresholds, 11.7 million, 23.4 million, they're very high compared to historical norms. This is the highest it's ever been. It's not out of the question that these amounts could be lowered. And so it's something to keep tabs on if your estates may be close to this amount, but not over. Pete, what would you like to add?
Well, there's going to be a lot of news on this issue. And so be careful of your moves that are irrevocable before you see the final outcome. Somebody mentioned the other day that, tax legislation and how tax law is formed is a little bit like watching hot dogs being made. You just don't want to see the process. And so you're going to see a lot of news on this issue, but it's all conjecture and we just don't know where it's going to land. So, and there's going to be a lot of professionals out there that will try and get you into their offices to make changes that may not be necessary. So just be cautious and and go slow. But talk a little bit more about the
Wait,
gift
Pete,
tax.
Pete,
Yes.
Pete, let's talk about the 11/7. Marty, when does that expire if no one does anything about it? 26?
Yes, 2026, that's scheduled to be reduced if
So if
there's
nothing
no
happens,
legislation changing.
it will revert back to about 5 million. If nothing is done by anybody, the law will change it back to roughly 5 in 2026. So
Well, something is going to happen, I believe.
something will happen, no doubt about that. But do know that even if they can't agree on anything, which seems to be occurring a lot,
Yeah.
this will trigger itself and go off in 26. So
Yes. See, and we just heard from God. So, okay. Talk a little bit about gifting.
Okay, so we see that first $15,000 figure as the annual gift tax exclusion. That is the amount of money that the IRS says any one taxpayer can give to another person and not have to report it to the IRS. Okay. And now think about that as a married couple, right? You can double that. So you can give $30,000 to any one person, one from each spouse. If you exceed that threshold, you are supposed to file a gift tax return. Now, this is an area where there's a little confusion because a gift tax return is merely the reporting of the gift over $15,000. There's no taxes due. No taxes need to be paid with the filing of that return. But it does in fact need to be filed in order to be compliant with the IRS rules. And what happens is when you exceed that $15,000, you start to chip away at this estate exemption amount to the extent you're exceeding the $15,000. So if you make a gift of $20,000 to another person, that first $15,000 is a freebie, so to speak, and the next $5,000 would reduce your estate exemption.
One of the biggest fears that people have is running out of money or having to lower their lifestyle because of money. And so this fear stops a lot of people from making gifts, even to their own family members, because the more money you have, the more secure you are. Can you ever be, or can you ever not be totally secure? So gifting is very difficult for individuals. But in this particular case, if we're running to the deadline, how do you help people understand that they can possibly make gifts, Marty, in your practice?
Yeah, so I think that comes down to financial planning and cash flow projections to show clients different scenarios based off of their current spending habits, growth of their assets, projected growth of their assets, and then just income moving forward. And we run through some really pessimistic scenarios to show that if somebody's still going to have more than enough assets, and even the most pessimistic of scenarios, it's okay for them to start thinking about giving away some of their assets.
And talk a little bit about cost basis and what do you want to go to the next slide to talk about that and capital gains, or do you want to talk about that here? Because it makes a difference as to what kind of gifts do you want to give to your children or to charity or timing during lifetime or at death.
Right. Yeah. So I'm going to stay on this slide for right now, Pete.
Okay.
But you raised some good points, because if you are at a point, where you're comfortable making a gift, right? You've gone through some analysis and you acknowledge that you can afford to give away assets. The first question is, well, who do you want to give those assets to? Okay. Is it going to be a charity, or is it going to be a family member or a friend? And then the next question is, what asset should you be giving to them? And that asset, the answer to that question may differ depending on if it's a charity or if it's an individual that you're giving money to. And so identifying the asset really comes down to answering a tax question around what's In some cases, it may just be simple. Maybe, hey, let's just do cash gifts, $15,000 or less to various individuals. In other cases, it could be much more complicated than that, depending on the assets in your balance sheet. Now, one of the things you brought up, Pete, was cost basis, right? And so if I bought shares of a stock, it could be, let's pick Apple, right? Apple's been a very high performing publicly traded stock over the last several decades. And so, you bought shares of Apple a couple decades ago, those are going to be highly appreciated if you've continued to hold those shares and not sell over time. If you were to sell those shares of Apple to try and give cash, you're going to incur a big capital gain tax, on the sale of those shares. So what you might instead do is give those shares directly to a charity, because charities don't have to worry about paying taxes. And the charity can receive shares of Apple, sell those, not pay the taxes that you would have paid, and instead keep 100% of the proceeds from the sale of those Apple shares. Now, that's going to look a little different if we want to give those to an individual, whether that be a family member or a friend. You give those shares of Apple to a family member or friend, they are still going to have to pay the capital gains taxes on those Apple shares.
And why is that?
What's that, Pete?
What is the rule on that? Why do they have to pay a capital gains tax?
Because the basis carries from you, the person that bought the shares of Apple, to them, the person that received those shares as a gift. And
does that go for stock, real estate, gold, for anything that you give?
Correct. Really, any asset that you're giving, that's going to be the case.
So in the estate planning area, we have a lot of times people put their kids on title to their house. When they put it on title, have they just made a gift?
Yes. Yeah.
So,
and that's where, people think they're doing a smart thing, because they may want the person they're adding the title to take over the house after they've passed. But the issue that creates comes down to understanding the tax laws. There's what's called a step up in basis on assets. So it could be the house, it could be shares of Apple, it could be anything really, where if you pass away with that asset in your estate and then have your estate documents direct that asset to that individual, the individual is going to be able to sell the asset and pay zero income taxes on it because of the step up in basis rules that are in place. So the value of the shares of Apple, again, the basis gets reset to the market value at your date of death.
So when they sell after your death, there's no tax.
Correct. No tax. So putting somebody on the title of a house that's got a very low cost basis may not give you the best income tax outcome, particularly if that person ends up selling the house at some point in time.
Yeah. The other one that's kind of comes to mind too is that people who own rental properties, they do 1031 exchanges, and so with depreciation and everything, many are reluctant to sell during their lifetime that real estate because of the capital gains tax.
Correct.
And we're going to talk a little bit more about that in the charitable section, because a lot of times rental properties have a really, really low basis. And sometimes you need the cash out of that during your lifetime. And we'll learn a little bit more about how a charitable trust might be a benefit in that area, just because of the tax issues.
Yeah. And so I think, Pete, one of the points you raised was the timing of the gift, right? Should you be making the gift during your lifetime or after you've passed, through your estate documents? And that really just depends. It sort of depends on your situation. But the step up in basis rules may make somebody want to wait and pass on that asset until after they've passed. The estate exemption, right, being what it is, makes that more likely for most taxpayers. That may be the case. If your assets are above this $11.7 million or 23.4, if you're married, then maybe you're looking more at lifetime gifts, giving away some assets during your life.
Let's go to the next slide.
Okay. Okay, we're moving on to the second type of tax that we want to cover today, property taxes in California. And California is unique in many ways. Property taxes is one of those, in part because of the appreciation we've seen here in the California real estate market that's outpaced really the rest of the country, probably for just about everybody's lifetime that's on this call. So
and it's probably the major asset in people's estate for the majority of people.
Correct. And so there's some new laws that we're working under that were just passed. It was Proposition 19. And so we wanted to cover these just to make sure everybody's aware of them. That first one allows persons 55 and older to transfer the property tax base of their primary residence up to 3 times anywhere in the state of California. So if you're over the age of 55, you've got a low property tax base on your home, and it could just be lower than the current market value, right? If you bought, really anytime, you're probably in that boat because the real estate values are at all-time highs in most of the state.
Yeah, and your property assessed value is not market value. So sometimes I get people say, oh, my property is valued X amount by the assessor's office. That's not market value. That's your assessed value.
Correct. And so you can move to a new residence and retain that low property tax base up to 3 times. The old rules only let you do it 1 time, and there was only certain counties in the state that let you do it. Now it's the whole state. You can do it as many as 3 times. There's some dollar limitations on that are important to take into mind, I think, but it's a nice benefit, I think, for a lot of folks as they age and get older. There may be reasons they want to move. Maybe the house they've lived in for decades doesn't make sense for their
exactly. My mother, same thing. When my dad died a couple of years later, she didn't want to mess with a 3-bedroom home and fix the roof and the yard, and she wanted to buy down. But yet to buy down, she maintained the property tax base that she had in the previous house because it was purchased for $35,000, and even buying down, it was over $100,000. So it really helped allowing her to move, and I think this will really benefit quite a few people when they buy down as they age. So talk about the $1 million of without reassessment. The primary residence parent to child, because that's really different than it was before.
Yeah, no, that's a big change. So if at the time of transfer, the difference between the assessed value and the market value of the home exceeds the $1 million, the new assessed value will be the fair market value less $1 million. So you're just retaining that low property tax base benefit on that first $1 million. Now, this is in the event of a transfer from a parent to a child after a parent's deceased and passed the residence on to a child. So they've limited that benefit.
Yeah. So and they both and they have to live in the house, right? Is that correct?
That's correct. And you see that bullet point here, the first bullet point there at the bottom. It's must be used as a primary residence of the child. Okay. And so if
you live in Laguna Beach and your home is worth $3 million and you want to pass it to your child, what happens?
You can do that, but the property taxes will still go up for the child. They won't be as high as they would if the child bought the house under a separate transaction, because there is a benefit on the first $1 million, but that amount over $1 million, so which would be $2 million on a $3 million house, would get reset and there would be a property tax increase, but
Okay.
there's still a benefit there.
All right, let's go to the next slide.
Okay. Okay, so we're looking at some income tax.
Yeah, let's go to the next slide.
Uh,
Okay. Marginal tax rates, taxable income, really, really important during your life and even at death, because as we've seen before, the estate and gift tax area is high, but even in the more than likely, even at your death, income tax planning becomes very, very important. And let's go through some of those things that somebody has to be aware of. Does your heirs have to pay income taxes from your IRA account, Marty?
yes.
So,
Yeah, because the money that went into an IRA or a 401k, 403b was done so on a before tax basis. So, if that was the case, your heirs will have to pay taxes. Anybody has to pay taxes on that money when it's taken out.
when it's taken out of the IRA,
Correct.
Right.
The only exception to that's going to be charities, right? And so that's why sometimes if you want to leave money to charities, we will look at IRAs as fantastic assets to leave to charities.
so let's say, for instance, you have $300,000 in your IRA account and you have one child, and in the year that you died, they have earned $100,000. Did I say 300,000 in your IRA? I think I
Yeah.
did.
Yeah.
So the individual in September, when you died, by the way, your IRA account is the first monies that are easy accessible for your heirs upon your death. And let's say they pull out the $300,000. What happens from a tax point of view when they do their tax return the following year?
Well, if they pull all the money out and they're making $100,000, they're going to have generated income of, it'll be $400,000 at that point. They'll be on their tax return, which means they're going to be paying higher tax rates.
So
on
they're
their
going to
money.
be, so they're going to be in the 35% marginal bracket.
Correct.
And what about California?
Yeah, California will be about 9.3% at that income level.
So you got 35, 9, you're hitting close to almost 50%.
That's right.
So even with a small IRA of 300,000 in your 401k, 457, in a SEP IRA, there's some real tax consequences here.
That's
How about
correct.
annuities when they withdraw monies out of an annuity? Same thing?
Same thing, ordinary income. So you're looking at these same tax rates here that as low as 10%, as high as 37% under the current laws.
So in the estate planning area, income taxes become really important.
Correct.
Besides during your lifetime, of course. How should people earn their money? Through a capital gain or through ordinary income?
Well, if you can pick, you want capital gains every time. And the reason for that is you can just look at the rates, right? So if we compare the rates for ordinary income, we see they range from 10% on the low end up to 37% on the high end, whereas capital gains rates are lower, right? There's only 3 brackets here versus I think it's 7 for ordinary income. So fewer brackets, but it's going to be less expensive to pay capital gains taxes than it is to pay ordinary income taxes. So it's a tax break to pay capital gains versus ordinary income. Now, California does not recognize capital gains. They treat everything the same. All income is the same. So no break with the state, but the IRS does give you a lower tax rate on capital gain treatment.
So let's say if I gift that Apple stock on my death and my heir sells it, do they have to pay a capital gains tax?
They do not because of that. Wait, I'm sorry. If you gift the stock?
No,
Yes.
if you gift it through your trust.
Oh, okay.
As
So-
a bequest.
Okay. So this person's inheriting
Yes,
Apple stock.
exactly.
So the Apple stock was stepped up in basis at your death. the Apple stock can be sold at market value, no gain at that point in time, no taxes.
Okay, so a chart is really important. Take a look at it, make sure you understand it. Let's go to the next slide.
Okay, standard or itemized. So that last slide looked at income and different ways to generate income, but to minimize your taxes, you want to find ways to reduce the amount of the income that's taxable income. In kind of two key ways to do that, you have to pick one of the two. One is the standard deduction. Okay, the IRS automatically gives you the standard deduction.
So if you wanted to itemize, you would have to be over your standard. Is that the rule?
Well, I think they'll let you itemize if you're below it, but it would be pretty foolish to do so. There's no benefit, right? You're better off.
They actually allow you to do that if you're below?
Yeah, as far as I know, they probably would. I don't think they would audit you if you were doing something.
But you have to be higher than that number for it to make sense.
Correct. So these are the different deductions that can be itemized. So if you want to add up these itemized deductions and see if they're going to be greater than the standard deduction amount, and if they are, you're better off itemizing the deductions.
Okay, a couple of things. Medical caregiving costs are medical. So make sure your tax preparer understands that. What about the $10,000 limit? I've heard the term SALT. What does that mean?
SALT stands for state and local tax. Okay, and that really means taxes paid to California, taxes paid to cities. We don't pay that tax here so much in California, but some states do have local taxes, and then property tax payments, right? So made on personal residences, second residences. So you can deduct those, but the problem is all those add up, oftentimes to more than $10,000 for taxpayers. The IRS says you're capped at 10,000 on all those. So that's a rule that came through with the Trump administration. And so right now that's capped at $10,000.
There's some changes in the gifts to charity. You want to talk about the IRA and can you still, if you itemize, if you take the standard deduction, can you still take a deduction for your gifts to charity?
If you are taking the standard deduction, the gifts to charity would not be taken as an itemized deduction. There are some small benefit potential that you can deduct in another place on the tax return. Okay. Probably the biggest one, the most noteworthy, is to make a qualified charitable distribution.
Let's go to
an IRA.
I think you mentioned that on another slide.
Yeah, that's in a later slide.
You want to go there, or I think we've got about 10 minutes left, I believe.
Okay. Yeah, so let me just touch on a couple other taxes here to be aware of. Okay, so the net investment income tax applies to single filers with over $200,000 of adjusted gross income, and over $250,000 for married filing joint. It's an additional tax assessed on capital gains and dividend income. And then you've got the state income tax rates that range here in California that need to be considered as well. So I like to just touch on those to make sure that we're aware of them.
Go ahead.
Okay, so in 2019, we had the Secure Act, which changed some of the distribution rules around retirement accounts.
Yeah, we'll go through those in the retirement plan section.
Okay.
Let's go to the next slide. I think this first one is really important point. You want to talk a little bit about it?
Yeah, so we're hearing a lot in the news and reading in the news that the Biden administration is proposing changes to income tax laws, and they're really focusing on raising taxes for people earning more than $400,000, taxpayers over
Is
that.
the $400,000 number gross, or is that 400,000 adjusted gross income?
You know, it's too soon to know what's going to come down. I've heard some saying it's taxable income, some saying it's adjusted gross income.
So even amongst the professionals, they're not clear.
Right. I don't worry too much about it yet because it's so
Okay.
hypothetical.
Okay.
It'll be debated and negotiated by the politicians, and then, hopefully we'll have something here before the end of the year to understand what it'll be moving forward.
Sausages are being made.
Correct.
Okay.
Correct.
Okay.
Yeah.
Let's go to, let's see, anything you want to focus on that's likely to happen in your point of view?
Yeah, I think capital gains rates will go up.
By how many, by what percent?
Well, here right now, the proposal is to go to 25% for those with income over $1 million. So again, you're seeing the tax being added for those high income people. Okay. I could see it going up. 25% is not out of the question. And, maybe it is on those with over $1 million. Maybe it's a higher number. Maybe that's lower, but I think there will be another,
another
bracket for capital gains added on there.
Okay. Let's go to the next slide.
Okay.
Let's see. Backdoor to spend a few minutes on the importance of Roth IRAs in tax planning having to do with death planning, because the difference in single tax rates and married filing jointly tax rates and all the income tax law changes. How does a Roth fit in all of that?
Yeah, so a Roth IRA is a unique asset in that the money in a Roth IRA can grow tax-free, right? So we talked about IRAs, 401ks, other retirement accounts is kind of working the other way. You put money in, you don't pay taxes on it on those accounts when you put money in. Roth IRAs are the opposite of that. And so with Roth IRAs, we frequently encourage people to not leave those assets to charity because a taxpayer can pull the money out of the Roth IRA and there's zero taxes due on those. So I think the ability to grow money in a Roth IRA and never have to pay taxes on that investment is a unique feature of a Roth IRA. There are limitations on getting money into Roth IRAs because of that attractive feature that they offer.
But you can always convert a regular IRA into a Roth, and you can do it over many years, and you can do it in varying amounts.
That's correct, Pete. And that's a big tax planning opportunity for people to consider if they know that their situation may change, if they're going to be in a higher tax bracket in future years. They may choose to accelerate income by converting some or all of their IRA to a Roth IRA. And by doing that, they're going to pay taxes on it in the year of the conversion. Okay. And that may be a good deal if they're going to be looking at higher tax rates in the future.
Yeah. The problem with sometimes with these kinds of programs, including ours, is that we put out ideas and they're not for everybody. And it depends on, and it may be not good for you today, but it may be 5 years from now. So it's a process that you go through because things change, and things are not always good, and things are not always bad. Where we talk about annuities most of all, and we have kind of a general statement that they're bad. Well, they're not bad in all circumstances. So I guess the point being is that don't put things in, don't take the advice or the information that we're giving you as being totally applicable for you. Take the idea and take it to your trusted advisor and see whether or not it applies to you, or if it's something that you should explore a little further down the road. We've got 5 minutes left. Let's go to the next slide.
Okay, here's some potential changes in the estate tax law, right? We touched on this a little bit earlier. Cost basis at death. So right now, it's being proposed that goes away. I think it's pretty unlikely
ever.
But maybe it goes away over some threshold, some dollar amount. But
it was not in the Ways and Means Committee report to eliminate the step up in basis. And I think most of your Congress and senators families would be very upset if they eliminated the step up.
Agreed. Yep.
Do you see anything happening that you, again, from your point of view, that might have a good possibility of passing?
Yeah, I do think the estate exemption will get reduced, right? That $11.7 million. I think it's going to end up somewhere in the $5 to $6 million, roughly half of where it is today. Okay. Instead of waiting until 2026, I think the Biden administration is going to want that to get cut back sooner. So that to me is kind of the low hanging fruit in the estate tax realm, is just to reduce that exemption amount.
Super. Let's go to your next slide, which I believe, let's see, we've got 3 minutes. Where should people donate to charity, from what type of asset and location, if you're over 70 and a half?
If you're over 70 and a half and you've got money in an IRA, that's a great way to give money to charity. And the way that you do it is called a qualified charitable distribution. It's the third bullet point down here. And the money is sent directly from your IRA to the charity. There's a form that gets filled out to direct your custodian, right, who holds the IRA, to give the money directly to the charity. The nice thing about that is it counts towards your RMD, right, your required distribution that you have to take out of the charity. However, you do not have to report that as income on your individual tax return. Cool. So you get a nice tax benefit while giving to charity. And this is one of those things we touched on, that you don't have to be itemizing your deductions to get that benefit. So if you're taking a standard deduction, you've got an IRA, you want to give money to charity, this qualified charitable distribution is still going to give you a tax benefit. And it's a great way to go about giving money to charity.
Yeah, you want to keep that adjusted gross income as low as possible, because it affects Medicare and lots of other things. So if you're going to donate, this is the area to go for. Let's go to your next slide.
Okay.
And there you are.
Here I am.
If we went through some of the issues a little quickly, but if anybody has a follow-up question, do you mind if they either email you or give you a call to ask you any questions from today's material, Marty?
I welcome the call or the email.
Okay, great. Thank you.
Why don't you stop sharing, Marty?
Okay.
Ta-da!
We've gone through questions along the way, and all of that has worked out. So I want to thank everyone very much. This has been the first week of It's Your Estate, covering introduction and tax planning. And we thank you very much for being here. And I'm going to stop a recording.